Hi everyone, welcome to our video on completing the accounting cycle. This video is going to be dedicated to closing the accounts. So the first thing we'll talk about is the accounting cycle and what it looks like. Now the majority of this we've already done at this point. So we're going to start with identifying a transaction. So when you're reading through a story when something has happened, you first have to identify that a transaction has actually happened, specifically with the party that you're doing the books for. So whether it be a company or what have you, you've got to make sure that, for example, the owner of the company didn't put a pool in their backyard. That is not a transaction of the business. So the first thing you have to do is identify that a transaction has actually happened. Then you want to analyze the transaction, determine whether or what accounts are affected and how they're affected, whether they're going up or down. Remember your rules of debits and credits. Then you're going to make your journal entries. From your journal entries, you simply post those to the ledger. So you're just simply moving information from the journal to the ledger. From the ledger, we'll take the balances in those accounts and create a trial balance. This is also called the unadjusted trial balance. Then we will make any adjusting entries that are needed, adjusting our accounts. And we talked about those 5 adjusting entries that you might have. Then you'll have your adjusted trial balance, again to ensure now that the balances in all of our debit accounts equal the balances in all of our credit accounts. Then we will create our financial statements. Once we've finished up our financial statements, we can close out temporary accounts and get them ready for the next reporting period. And after we've closed our accounts or made those closing entries, we'll do another trial balance called the post-closing trial balance, again to ensure that all of the accounts with debit balances add up to be equal to all of the accounts with credit balances. So let's jump into this closing process and what that looks like. So the closing process really does 2 things. The first thing is it prepares the accounts for recording transactions in the next period. It also updates the retained earnings account. Now we have to be aware of what accounts we're actually closing and what accounts do not close, what accounts remain open. Permanent accounts, which are also called real accounts, are accounts that are not closed at the end of the period. These are your balance sheet accounts. Okay, so you leave those accounts alone. So for example, your cash account, you're not going to close out your cash account at the end of the year and start at 0 every single year. That's not how that account works. So that's called a permanent or real account. Nominal or temporary accounts are accounts that are closed at the end of the year. And these are accounts specific to the income statement. So accounts like your revenues and expenses, those will get closed. So let's look at the 4 types of closing entries that you may or may not see. So the first one is we're going to close the revenues to something new called the income summary. The income summary is really a super temporary account. It just kind of appears when you do the closing process, and then when you're done with the closing process, it's gone, it disappears. And you'll see that as we go through this process. So the first thing we want to do is close the revenues to the income summary. So I've created the income summary in a little T account here. So let's think about this for a second. Revenues carry a credit balance, a normal credit balance. To get rid of a credit balance, I would have to debit those revenue accounts. Well, always remember, if you debit something, you have to credit something. And the thing that we are crediting here is the income summary. So remember, this is a T account, and we're putting those revenues on the credit side of the income summary. So we're basically just moving them from the revenue accounts to the income summary. The second thing or accounts that we will close are your expenses to the income summary, and you have to close all the expense accounts individually, and we'll see that here in a second with our journal entries. So let's think about expenses. they carry a normal debit balance. So to close those out to zero, we would have to credit those expense accounts. If you credit something, you have to debit something. And if you notice here, we are debiting the income summary for our expenses. Then we can calculate net income inside that income summary account, because you can see we have our revenues minus expenses equals net income. So now we're left with net income, or the net income amount, in our income summary. Well, we don't want the income summary to be there. We want it to go away. So now we're going to close that income summary account. Well, notice if we have a net income number here, to get rid of that, we would have to debit the income summary, and we would credit something. In this case, we're closing it to retained earnings. So we would credit retained earnings. Now think about this a little further. What if expenses had been higher than revenues? Would we have had a net income? No, we would have a net loss. And in that case, the income summary would have had a debit balance. So to get rid of a debit balance in the income summary, I would have to credit the income summary. If you credit something, you have to debit something. We would have debited then retained earnings, thereby decreasing retained earnings. And the last thing we close is dividends, and then they get close to retained earnings as well. And we're going to see each one of these here in just a second. So let's look at some examples. So here I've given you some balances in the revenue and an expense account. We only have one in this instance, but usually you'll have many, and keep in mind you have to close each one of them. So revenues in this case has a $500 balance, and our expense account has a $200 balance. So the first thing we want to do is close our revenue account. Well, to get rid of that $500 in my revenue account, which is a credit balance there, I would have to debit my revenue account. And if I debit something, I have to credit something. And you will see I have credited the income summary for that $500 in revenues. And my revenue account is now zeroed out. So it's now ready for the next reporting period. The next thing we want to do is close our expenses, again to the income summary. Well, my expense account has a $200 debit balance. To get rid of that debit balance, I would have to credit the expense account for $200. If you credit something, you have to debit something, and we're going to debit the income summary. Now notice my expense account now has a zero balance. So it has been zeroed out, and it's ready for the next reporting period. And you'll notice down here, my income summary currently shows a balance of a $300 net income, but we'll see that here in a little bit more in a second here. Okay, so expenses are 200 in the debit side, revenues are 500 on the credit side of our income summary. So the next thing we would do is compute net income, as we kind of did in the previous slide. So we know we have a credit balance here of $300 net income. However, keep in mind, the income summary is a super temporary account. We don't really want it there. So to get rid of that credit balance, we want to close the income summary. To get rid of that credit balance in the income summary, I would have to debit the income summary. If you debit something, you have to credit something, and we close the income summary to retained earnings. So now our income summary has a balance of zero, and it kind of disappears. It goes away. The next thing we would do is close our dividends account. So our dividends account currently has a $100 debit balance in there. Remember, dividends kind of acts like an expense, although it's not, because it doesn't appear on the income statement. It appears on the statement of retained earnings. So it's a payment to our stockholders. So to get rid of that debit balance in dividends, we would have to credit dividends. If we credit something, we have to debit something. We would debit retained earnings. Remember, debits decrease retained earnings, which makes sense because dividends is a payment to the owners, and retained earnings is defined as money that is not paid out in the form of dividends. So if we pay dividends, it would reduce our retained earnings. And now the last step is simply to compute our ending retained earnings. So retained earnings carries a credit balance. So we have a beginning balance of 1,000 plus net income of 300 minus dividends of 100 would leave us an ending balance in retained earnings of $1,200. Now I'm going to show you a completed worksheet, which we've seen worksheets in the prior video. So I'm going to complete a worksheet for you. I'm not going to go through it all with you, but hopefully you remember from the prior video how to create a worksheet and how that works. But there's specifically things I want to show you in this one. In the prior worksheet we showed, we only went through the adjusted trial balance, and then we went through to the income statement, or to the financial statements. First one being the income statement and then the balance sheet. So remember, we want to move the accounts from the adjusted trial balance into the financial statements, whether it be the income statement or the balance sheet. So we'll move the balance sheet accounts into the balance sheet columns, the income statement accounts into the income statement columns. The oddball here is really dividends, because dividends do not appear on the income statement and they don't appear on the balance sheet. But the dividends account would move through to the balance sheet columns because the retained earnings amount appears on the balance sheet. Okay, so keep that in mind. But now from this worksheet, we're going to pick out the accounts that we need to now close, since that's what we're focusing on here is closing entries. So we know that we need to close all of our revenues, all of our expenses, and our dividends. So I have circled them here for you, or actually put them in a square, so that you can pick those out, what needs to be closed. I would like for you, if you've got the lecture notes printed out that I provide on my website, complete the closing entries. So remember, the first thing you should do is close your revenue or revenues. The next thing you should do is close the expenses. The next thing you should do is close the income summary, then close the dividends. Okay, so you should have 4 closing entries here. So press pause the video, and work on these 4 closing entries, and then come back and we'll take a look at them together. All right, let's take a look at the first 2. So here I've closed revenues to the income summary. We only had 1 revenue, service revenue, of $7,400, and I closed that to the income summary. We had 5 expenses. Now remember what we said earlier, you have to close every individual expense account, and you can do that in 1 entry. We call this a compound entry. So all 5 of those expenses, so $100 in depreciation expense, $2,300 in salary expense, $800 in rent expense, $700 in utilities expense, and $1,600 in supplies expense, add up to $5,500. Now, why didn't I just credit expenses? Well, there's no such account called expenses. Every expense is important, and so each expense gets its own account, and you have to close each one of them individually. So that's why you see every one of them listed there. So we've closed our revenues to the income summary. We've closed all of our expenses to the income summary. Now we would calculate our balance in the income summary, but I didn't draw a T account here. Maybe you did, but you can see that we have a credit to the income summary of $7,400 and a debit to the income summary of $5,500. So the difference there is a credit balance of $1,900. So to get rid of that credit balance in the income summary, I would have to debit the income summary for $1,900. And the income summary gets closed to retained earnings. So I would credit retained earnings. The last entry is to close dividends. Dividends carries a normal debit balance. To get rid of that, I would have to credit dividends for $2,000, and dividends get closed to retained earnings, and effectively they reduce retained earnings, and retained earnings do decrease with a debit. So in this case, it totally makes sense. It's decreasing with a debit. Thank you for watching the video. I hope that you learned something from it. Please give it a thumbs up. If you enjoyed the video, please consider subscribing to my channel. Also, visit me online at theaccountingdoctor.com, where you can find those lecture notes I was telling you about, as well as other videos and other course information. Comments are always welcome, and thank you for watching.